Now see, what we've already done till now is, we knew that there are three major financial statements which are required to be prepared. The first financial statement is balance sheet, and which is all about assets and liabilities. The next set of financial statement is income statement, which was primarily about your incomes and expenses. Now the third statement, which is more important than the first two, is the cash flow statement. And why do I say that it's more important? It's because that when you prepare balance sheet and income statement, you're using accrual system of accounting. That means you might be booking sales where you've not received cash, so not necessarily all the sales were genuine. But when you prepare cash flow statement, it talks purely about how much cash has been generated, and therefore cash generated is a true measure of business compared to other statements of or other measures of income. So what is this cash flow statement? Of course, it tells us that it's all about cash. Now understand this from a logical perspective. Let's say that in your 2005 balance sheet you have cash balance of 150 rupees, and in 2006 balance sheet you have a cash balance of 400 rupees. So your cash is increased by what amount in 1 year? Your cash is increased by 250. So cash flow statement is all about this 250. You want to find out that how exactly this 250 has been generated by the organization. So you will try to divide this 250 into three major categories. You will try to find out that how much of this 250 has been generated through the core business related activities of the organization. How much of this 250 is generated by making sales of the asset, because if you sell assets you generate cash, or how much of this 250 has been generated by taking loans. So the first set of cash which has been generated through core business activities of the business, we call those cash flows as cash flow from operations, CFO. The set of cash which has been generated by making sale of assets or sale of other investments, we call them as cash flow from investing activities, CFI. And the set of cash which were generated by taking loan or by raising money through equity share capital or preference share capital through the financing activities of the business would be called as CFF. So these would be three major categorization: cash flow from operations, investment and financing. So what can happen now is that total cash generated is 250. So this might be 100, this might be 100, and this might be 50. So through my business I generated 100, through selling some of the assets I generated 100, and then by taking loan I generated 50. So total cash increased by 250. It can be 300 minus 50 and 0. Through my business I generated 300. I have invested 50 into some assets of my organization. I have not taken any loan for this year. It can be 500 minus 50 minus 200. I have generated 500 by taking loan. Out of that I have invested about 50 into some fixed assets, and I have incurred a cash loss of 200 in this particular year. So I have lost, or I have spent more cash than what I have received, and therefore my cash flow from operations here is negative. So these can either be negative numbers or positive number. A positive number would mean an inflow, and a negative number would of course mean an outflow. So if you see a negative number in cash flow from investments, what you would interpret is that company must have invested into some assets of the company, or company must have invested into equity shares or any of the investment vehicle. If you see a negative number in cash flow from financing, you would interpret that company must have probably repaid some amount of loan. And if you see a negative number here, then you would interpret this as the company has spent more cash in business operations than what it has received. Are we okay with this? Now see, as far as the CFA Level 1 is concerned, you are asked a lot of logical questions from this topic. Now, this cash flow statement can be prepared in two possible ways. The first method is called as direct method, and the next method is called as indirect method. Now, direct method is something which is relatively straightforward, so we don't have to worry about it way too much. It's the indirect method which would make life a bit difficult for the next few days. Now, this direct and indirect method is concerned only with cash flow from operations. That means no matter which method you are using, the cash flow from investments and cash flow from financing is going to be almost same. It's the cash flow from operations which is going to be different in direct method and indirect method. So now, the best way to learn this is learn it through a logical way. So if you open your book, you'll find that there are at least 10, 15, 20 formulas given, and it becomes very difficult to memorize them. So the best way to understand is that you need to be really strong with the logical flow of income statement. So when you make an entry of sales, what happens? Sales goes on to the income statement. Ultimately, the net effect is going to go on to the equity side of the balance sheet because sales is income. The second effect would be on the asset side. It can either be cash or it can either be accounts receivable. So when you are really clear with this logical flow of financial statement, then cash flow would start making sense to you. So the way we will do it today is, I will give you a set of transactions. On those transactions, you will prepare balance sheet, you will prepare income statement, and then we will prepare cash flow statement using both direct method and indirect method. You can have these examples with me. Is it visible? Start making balance sheets based on this transaction. Please prepare a balance sheet and profit and loss account for a given set of transactions. Amount would be 30 lakhs. zeros here. Okay. Second, what should be second effect of this transaction?
Cash.
You will have cash. Cash would be 30 lakhs. What is next? Bank loan 15. Again, bank loan is a liability. So bank loan 15 lakhs. Second effect, now your cash will be 45 lakhs. Now we can in fact have totals. Balance sheet is getting tallied after every transaction. Next one, plant and machinery purchased 10 lakh. Plant and machinery is an asset. So plant and machinery here 10 lakhs. Second effect would be cash will reduce by 10 lakhs. So now cash is 35. Again balance sheet total is 45. Then next transaction is sales of 10 lakhs in cash. So now sales of course would go on to the income side. Sales 10 lakhs. Second effect would be cash will increase. So plus 10 lakhs. Again now at this stage my total here is 55. Total on the liability side is 45, and that is precisely because there is one item that lies in my income statement. If I close my financials now, my profit would be 10. That profit would be transferred to capital, so that again total would be 55 and 55. But at this stage we don't want to make the transfer, so let's wait. Next, sales is on credit 10 lakhs. So again we'll call this as sales to 10 lakhs. Second effect would be now accounts receivable. So now your accounts receivable, instead of adding cash on the same side, you are adding it to accounts receivable 10 lakhs. Employee expenses cash 5 lakhs. Employee expenses 5 lakhs. Second effect, cash will reduce minus 5 lakhs. So now cash is 40. Other expenses 1 lakh. So other expenses 1 lakh here. Cash again will reduce by 1 lakh. So now cash is 39 lakhs. We posted all the entries. Now what we have to do is finalization. We'll have to calculate profit, which would be the balancing figure. And profit amount is 14 lakhs, so that balance sheet total is 20. Now, once we have this profit, that profit we would transfer on the liability side. So you'll say profit 14 lakhs. So balance sheet total is 59 and 59. Now, how could you do this orally? What you know is that when you see any set of transactions, see here, you see any set of transactions, with the asset side the difficulty is that this cash balance keeps on changing. Look at the formula here, the cash balance will keep on changing after every transaction. So estimating what would be amount of cash becomes a bit difficult. But what we know is that total of liability side and total of asset side is going to be same. So we try to guess what would be the liability side. So what do I have on liability? I will have capital, I will have bank loan, and of course I will have profit. So this two total is 45. I calculate profit already. Sales 20 lakhs minus 6 lakhs, profit would be 14. So 45 plus 14, this total has to be 59. If this is 59, plant and machinery is 10, accounts receivable is 10, then cash has to be 39. But you don't want to do it this way. Okay, this is called as forcing your balance sheet to tally. Don't do it the way we have done it as of now. Is this clear? Anyone with doubts here? In case if you have doubts that this sales on credit, we follow accrual system, irrespective of fact that whether you received it in cash or not, entire sales goes on to the income statement. Now, cash flow statement is about this number. So we want to know that how this 39,000 has been received. So we'll prepare a statement, cash flow statement. We will not worry about formats at this stage. Let's do it here itself. So this is my cash flow statement. We'll divide it into three categories: cash flow from investment, cash flow from operations, investment, and cash flow from financing. Now, first cash is started business with cash 30 lakhs. So I have received this 30 lakhs, it's an inflow. Where should I show it? Started business with cash. That means I have received this capital. Where should I show it? Financing. I should show it in financing cash flow. It's a financing related activities and it is an inflow. So I would say a positive 30 lakhs would come down here. While writing, you people would also write down that this 30 lakhs is for capital. Now, next is bank loan 15 lakhs. Where should I show it? Financing. So again, I am going to show this as positive number because I have received this cash. Plant and machinery purchase 10 lakhs. Where should we show it? Plant and machinery. Plant and machinery would be your investing activity. When you buy and sell assets, buy and sell equipments, buy and sell investment, all of them come into investment activities. So we will say that this is going to be negative 10 lakhs. And why is it negative? Because the cash has gone out, it's an outflow. Next one, sales in cash 10 lakhs. Where should I show it? Sales in cash would be operating. So I will come to cash flow from operations, and since I have received this, it will be shown as a positive number. Sales on credit 10 lakhs. Where should I show it? I have received this 10 lakhs? No, I have not. So should I show it? No, I will not. Why? Because it is a non-cash expenditure. Right? We have not received this 10 lakhs in cash, so we are not going to worry about it. We are going to completely ignore. So I don't do anything about sales on credit in my cash flow statement as of now. Next one, employee expenses 5 lakhs. Where should I show it? Again, operations, and it is a negative cash flow because it is an outflow. So minus 5 lakhs. Other expenses again would be my operations 1 lakh. So now I have categorized all the cash transactions into three categories: CFO, CFI and CFF. Now I will simply take the totals of these amounts. So my total is 4 lakhs from cash flow from operations, minus 10 lakhs from cash flow from investment, and 45 lakhs from cash flow from financing activity. And then I will take total of these, and then I would say this amount plus this amount plus this amount, and the total would come out to be 39 lakhs, which was exactly the amount of cash that I had in my balance sheet. And why is it same in this year? Because originally my cash balance was 0. This is my first year of operation. My cash has increased by 39,000. So we are trying to find out how did your cash increase by 39, and this is what your cash flow statement is. Is this clear? Anyone with doubts here? Are we clear? Okay. Now see, can you notice that in your CFO, all the items that you have are generally the items which would go to your profit and loss account? What do you have here? 10 lakhs of sales, and again 5 lakhs of employee expense, 1 lakh of other expense. Generally the items you should go to your profit and loss account. So now my next question is, can I try to estimate this cash flow from operations of 4 lakh rupees if I have this profit and loss statement with me? So this is the profit and loss of the company. Can I try to estimate the amount of cash if I look at these numbers? How much is profit? 14, whereas cash flow from operations is 4. Ideally they should have been same. Why are they not same? Because there are certain items here on my income statement which were non-cash. So how do I figure it out? If there are some items which are non-cash, generally the impact of those items you would be able to see in your balance sheets. So if you observe your balance sheet carefully, in the last year you did not have any accounts receivable, but this year you have accounts receivable of 10, which means that accounts receivable has increased by 10. That means in this year you must have made trade sales of 10. So that means if I have two sales of 10 and 10 here, one of them has to be a trade sales. Are you following this? Now in this case of course we know it, but even if I did not know those transactions, only by looking at this number I would say that 10 must have been the trade sales, and therefore though profit is 14, this one of them is not trade sales, I should not consider that. So if I consider only 10 as the cash sales and 6 as the cash expenses, my answer would come out to be 4. So then this method where you try to find out cash flow from operations using the profit is called as indirect method. So this method that we studied here was the direct method of cash flow from operations. Indirect method would be start with profit and adjust profit for non-cash items. So your profit here was 14 lakhs and you would say less credit sales so your cash flow from operations 4 lakh. The answer is same, it's just the methodology which is different. Yes, please ask questions. Any doubts? Anything not clear? Yes, back there, Vivek. Is it okay? It's clear? Deepak, Mebin. Should we do next example then? Okay. Prepare balance sheet, profit and loss account and cash flow statement using direct method and indirect method. Amount of capital would be 10 lakhs. Next one is bank loan. amount would be 25 lakhs. Both of them will have second effect in cash. So cash, so 10 lakhs plus 25 lakhs, 35 lakhs. Plant and machinery 5, which would be on the asset side. So plant and machinery 5 lakhs. Second effect would be reduction in cash, so minus 5 lakhs. Depreciation 1 lakh. So depreciation is an expenditure. So you will say depreciation amount is 1 lakh. Second effect, cash will reduce by 1 lakh.
No.
Depreciation is a non-cash expense. So plant and machinery will reduce by 1 lakh. So you don't reduce cash when you charge depreciation, you reduce the respective asset. Then sales 20 lakhs. Irrespective of whether it's cash or credit, entire sales would go onto your income statement. But cash will increase only by half of the amount. So cash will increase by only 10 lakhs. Remaining 10 lakhs would be shown as accounts receivable. Next transaction, expenses 5 lakh. So expenses 5 lakhs here. Cash will reduce by 5 lakhs. So now total cash is 35 lakhs. Take the total. This total is 49, this total is 35 because we have not transferred profits yet. This is 20, this is 6. Profit would be the balancing figure. So profit is equal to amount minus sum of these two. So your profit would be 14 lakhs. This profit needs to be transferred here. Profit of 14, which will give you a balance sheet total of 49 and 49. So, is there anyone who could not get correct profit? Anyone who could not solve up to this? Okay. So then next stage is cash flow statement. So this is your cash flow statement now. We'll divide it into three categories: CFO, CFI, and CFF. First transaction, capital is it's an inflow in financing activities. So we'll say positive 10 lakh in financing activity. Next transaction, bank loan is again inflow in financing activities. Plant and machinery is a outflow in investment activities. Depreciation is an outflow in it is a non-cash expense. When I charge depreciation, my cash goes out. My cash goes out when I purchase the asset. When I charge depreciation, there is no cash flow, and therefore depreciation is to be ignored. Then sales, 50% cash. So my 20 lakhs would be the inflow here. My inflow is 20 lakhs. My inflow is only 10 lakhs. Expenses 5 lakhs is the outflow from cash flow from operations. So we'll take the total. The total is 5 lakhs, 5 lakhs and 35 lakhs. So total of all the cash flows is 35 lakhs, and it tallies with the cash balance because our cash is also increased by 35 lakhs. Anyone with doubts here? Now this method that we've done for cash flow from operations is the direct method. If you have to do it using indirect method, so with indirect method, the starting point is profits. We start with profits, and the amount of profit is 14 lakhs. And this profit we adjust for those items which were not in cash nature. So see here, sales is 20, but what I figure out is that accounts receivable has increased by 10. That means half of the sale must have been on credit. So my cash sales is only 10, but here I have added entire 20. So what I need to do is I need to undo the effect. So I would say less credit sales. Are you following this? That whatever I have done in the past, I have to undo that effect because it was not cash. So less credit sales, 10 lakhs. Next one, depreciation, which is again not a cash expense, but I have deducted it. So I have to undo the effect. So I have to add it back. So I will say add depreciation is 1 lakh, and I take the total, and again my cash flow from operations is going to be same. Yes, please ask questions if you have any doubts. Any doubts, or is it clear? Why do we add depreciation? See Deepak, when we start with profit, we start with this number. So इसको ऐसे देखो, ठीक है? कि हमने किसी non-CFA, we've asked some non-CFA guy to prepare cash flow. So what he says is, he prepares a list of those items where cash is received. Okay, so he says receipts. हम लोग ऐसे करते हैं add, तो कहता है add sales of 20 lakhs. Now then he makes a list of items that needs to be deducted. He says depreciation 1 lakh, other expenses 5 lakhs. So he gives us the final profit, and he says this is the cash flow. Now you're a CFA guy, you start with this number and you're trying to find out what mistakes he's done. So you look at this sales of 20 which has been added, but then you say that entire 20 should not have been added because entire 20 was not in cash. So the fact that you've added, this has already been added, you need to undo the effect. Ideally you should have added only 10, but because it's added 20, so you need to minus it. So then you would say you are adjusting this profit, so you would say less credit sales and less credit sales would be 10 lakhs, half of it. Then you again look at the expenses, and what you figure out is that this depreciation has been deducted, whereas it should not have been deducted because it is not cash. So you say add depreciation 1 lakh, and then you adjust these items now, then it gives you the correct cash flow. Clear? So you basically start with profit, and whatever adjustments which have been done into profit and loss account, which were because of accrual system, you undo them and you try to bring it to your level of cash. You want to do the next one? prepare profit and loss account, balance sheet and cash flow statement. Amount is 30 lakhs. Second effect, your cash is going to increase by 30. Next one is bank loan 25. Cash will be 55. Building 10 lakhs, which is an asset. Now cash will reduce. Plant and machinery 5 lakhs, again an asset. Now cash will be 40. Next one, depreciation on fixed assets. That means depreciation on these two assets, 15 into 20%, depreciation would be 3 lakhs. Now second effect is that I will reduce the value of plant and machinery by 20%, so this would become 4 lakhs. And this would be 8 lakhs. Next item is sales, 50 lakhs. So entire sales goes here. But my cash will increase only by 70% of this, which is 35 lakhs. So let's increase the cash by 35 plus. So cash now is 75. Second effect, I will have accounts receivable of those 30%, 15 lakhs. Next item would be manufacturing expenses 20 lakhs. Cash will reduce by 20 lakhs. Next item is salary 10 lakhs. Salary 10 lakhs here. My cash will reduce by only half of the amount. Though entire salary is expense, cash will reduce by only 5 lakhs. So we'll say minus 5, and the remaining 5 would be shown as accounts payable, or rather we will call them as outstanding salary of 5 lakhs. Now we'll calculate our profits. So now your profits are 17. Let's transfer these profits here. So that balance sheet total is 77 and 77. Please ask if you have any doubts, any questions. Deepak, back there, Sheetal. Is this clear? So now once we have balance sheet and profit and loss account, we can prepare our cash flow statement. Again, 3 parts: cash flow from operations, cash flow from investments, cash flow from financing activities. Now capital should be shown as cash flow from financing 30, bank loan again financing, building investments, it's an outflow, so negative number, plant and machinery investments, depreciation to be ignored, sales 50 lakhs but 70% is on cash. So now we will say cash flow from operations is 35 lakhs. Next one, manufacturing expenses 20 lakhs, which would be an operating outflow. Next one, salary, again it would be a operating outflow of 5 lakhs. Then we'll take the totals. We'll take the total of all of them. It would be 50 lakhs, which would tally with your final balance. This method, of course, was the direct method. With indirect method, I have to start with profit. So amount of profit here is 17 lakhs. Now I look at this profit income statement carefully. I look at the balance sheet carefully. Sales is 50, but is any part of the sales made on credit? So I look at the accounts receivable. It has increased by 15. That means my sales of 15 must have been on credit, but it has been added, so I need to deduct it. So now I'm saying less, and instead of saying credit sales, now I'm saying increase in accounts receivable. Same thing, increase in accounts receivable means it must have been credit sales, and that amount is 15 lakhs. So less increase in accounts receivable 15 lakhs. Then again we are on to the income statement. Sales 50 well taken care. Depreciation 3, this has been deducted, so we want to add it back. So we'll say add depreciation, and amount is 3 lakhs. Again we are on to the income statement. We look at these expenses of 20, and then all of these expenses are on cash. If some of those expenses were not in cash, it must have reflected on my liability side, because if I incur some expense and I don't pay it in cash, then it becomes a liability. But there is no outstanding expenses here. That means all those expenses are in cash. Salary 10, but I look at my liability side and figure out that outstanding salary is 5. That means I must have paid in cash only 5, but I have deducted all the 10. I should add back the ones which is not paid in cash. So I will say add salary not paid in cash, and salary not paid in cash was 5 lakhs. And then once this is done, then we take total of all these numbers. The total comes out to be 10, which matches with what cash flow from operations we had earlier. Yes, any doubts, any questions, please ask. Any doubts, anything that you want to be resolved. So if you don't understand this now, you will find it extremely difficult later on. If you don't understand anything, please ask. Sheetal, Sangram, maybe this is okay. So I think we'll stop for the day here.